Hello everyone, and welcome back to the channel. Around 9.5 million Americans are now in default on their federal student loans, the highest number recorded. That is roughly 1 out of every 5 federal student loan borrowers. Behind that number are millions of individual crises. A damaged credit score, a rejected apartment application, a car loan offered at a punishing interest rate, a mortgage delayed for years, a tax refund that may eventually be seized, a paycheck that could be garnished, and for many borrowers, the psychological burden of carrying a debt that has followed them from early adulthood into middle age. The total federal student loan portfolio is approaching $1.7 trillion. By March 2026, official federal student aid data showed approximately 9 million borrowers with around $220 billion in loans already in default. More recent reporting placed the number at approximately 9.5 million borrowers and $233 billion in defaulted debt. This did not happen because 9 million Americans suddenly became irresponsible. It happened after the federal government restarted a repayment system that had been largely suspended for more than 3 years during the COVID-19 pandemic. Payments resumed. Temporary protections ended. Millions of borrowers discovered that their financial lives had changed, but the debts had not. Some had experienced unemployment, others were paying much higher rents, food prices, insurance premiums, and childcare costs. Some had aged into retirement, many had never completed the degrees for which they borrowed. And millions were trying to understand a repayment system being repeatedly altered by elections, litigation, administrative backlogs, and changing government policy. The immediate crisis is about missed payments, but the deeper crisis began much earlier. It began when the United States chose to finance higher education increasingly through individual tuition payments rather than treating university education primarily as public infrastructure. The result is a cycle. High prices create heavy borrowing. Heavy borrowing creates repayment risk. Repayment failure damages credit. Repayment failure damages credit and reduces household spending. And the people who receive the least economic benefit from college are often the most likely to suffer the harshest consequences. When COVID-19 disrupted the American economy in 2020, the federal government paused payments on most federal student loans. Interest rates were temporarily reduced to zero, and borrowers were not required to make regular monthly payments. What began as an emergency measure continued through several extensions. For more than 3 years, tens of millions of people organized their household finances without a student loan bill. Some used the additional money to pay rent. Others paid down credit cards, supported children, covered medical expenses, or simply survived a period of economic instability. Interest began accumulating again in September 2023, and most borrowers were expected to resume payments in October 2023. But the government created a temporary 12-month on-ramp period during which missed payments would not immediately be reported to the credit bureau. Delinquencies then began appearing on credit reports in early 2025. Because a federal borrower generally must miss approximately 270 days of required payments before entering default, the first large wave did not appear until late 2025. This delay is important. The crisis did not begin the day payments resumed. It moved gradually through stages. First, a borrower missed one payment, then several. The loan became delinquent. Credit reporting resumed, crossed into default. The 9.5 million figure therefore represents the accumulated consequences of decisions and financial difficulties that began months or years earlier. New York Federal Reserve researchers estimated that approximately 1 million borrowers entered default during the final quarter of 2025. Another 2.6 million entered default during the first quarter of 2026. The share at least 90 days delinquent reached 10.3%. The average borrower entering default was nearly 40 years old. Recent defaulters were older than those who defaulted before the pandemic. There was a noticeable increase among people aged 50 and above. This challenges the stereotype that student debt is primarily a problem for 22-year-old recent graduates. Many borrowers have been carrying these obligations for decades. Some are parents who borrowed for their children. Some have balances that grew because their payments did not cover accumulating interest. Older borrowers have fewer working years to recover. Defaults have been especially concentrated in the South. At least 10% of borrowers newly entered default in these states. No region was unaffected, but the geography reflects broader inequalities in income, employment, college quality, and household wealth. One of the most revealing findings is that most people entering default were not already delinquent before the pandemic. More than 3/4 were either current on their loans in 2019 or did not yet have a payment due because they were still studying. Only about 1/4 had already been behind before the payment pause. For millions, the repayment breakdown was new. Their rent may have risen. Their family responsibilities may have changed. Their income may not have kept pace with inflation. A borrower who could afford a payment in 2019 might not be able to fit it into a 2025 household budget. There was no old normal to return to. A federal student loan does not enter default quietly. The consequences can follow a person into almost every part of economic life. A damaged credit score can affect the ability to rent housing. It can make a car loan more expensive. It can delay home ownership. The government also possesses collection powers unavailable to a private creditor. Federal law allows wage garnishment and tax refund seizure. For borrowers already struggling, eventual garnishment would not simply recover money, it could push a household deeper into financial distress. The deeper cause is the American approach. Compare this with other countries. In Germany, most public universities do not charge general tuition. Iran offers tuition-free daytime programs for competitive students. China subsidizes public universities with fees far below typical American prices. These examples demonstrate that very high tuition and mass student debt are political choices, not unavoidable laws of economics. The cycle is simple. High prices create borrowing. Borrowing creates repayment failure. Default damages credit and reduces economic freedom. For 9.5 million Americans, the financial instrument designed to open the future has instead become a barrier surrounding it. Thank you for watching. Make sure to like the video, subscribe to the channel, and share your thoughts in the comments.